So Dan, it's been a fantastic year for the muni market in general. A lot of assets coming in, strong performance for credits. Do you expect something similar for 2020? What's your outlook?
Well, it has been a great year this year, and I think at this point last year, no one would have expected the way it's turned out. Everything you can do to take more risk has worked, whether it's longer maturity, more credit risk, everything has worked. So looking where we are now and where we could go from here, the key things in our market are really, in the municipal bond market, are supply and demand. So on the supply side, the 2017 tax bill really reduced the supply of tax-exempt bonds. And there's no sign of that changing because the tax bill still is out there. So our supply should stay lower than it was a couple of years ago, which is beneficial for the market. On the demand side, tax bills had a big impact there too, with the cap on state and local taxes causing people to really be looking for whatever tax exemption they can find. And that's driven our strong demand this year. And as we're getting towards the end of the year, the demand is not slowing down. If anything, it's increasing, and people are getting very comfortable. So they've made money in equities. They're comfortable taking some of their money and putting it in the municipal bond market. So looking forward, supply should stay average to maybe on the lower side, but maybe slightly higher than this year. Demand should be consistent. And those are the main things we're looking at going forward that should put some comfort in the market. And then if you move to the interest rate side, rates are on the lower side. They've rallied this year, but there really is no sign of inflation, and growth is under control. Globally, rates are on the lower side. So it seems like everything suggests we're not going to see any big increase in rates. We should be in a pretty comfortable environment this year.
So technicals are pretty positive. Looking at the fundamentals side of things, as you say, supply is limited. There's been a lot of concern about deteriorating fundamentals, perhaps in corporate credit, or how long can the U.S. consumer sustain this? Certainly an explosion in the federal deficit. Are we seeing the same kind of thing with a lot of municipal credits?
Municipals have been performing very well from a credit perspective too. It's been kind of an incredible year. I mean, everything really is working, but it kind of started when people were paying their taxes, and when you kind of go back to the tax bill, and people used to prepay them in the calendar year before they're due. This year they didn't do that. They paid them in 2019. So tax revenue came in late, but it came in very strong, above budget. Most states had surpluses. Putting money into rainy day funds, putting money away, just having extra money to make their pension payments. It was really good shape in our market this year. If you turn to the rating agency side, more upgrades and downgrades in every quarter from the rating agencies. Their credit quality is really doing well. So you have state balance sheets looking good. You have credit fundamentals looking good with the rating agencies' perspective. And then overall, just the economy is moving along at a good pace. It's not booming, but it's not shrinking either. And that means things like oil prices are on the lower side, so transportation credits are doing well. Healthcare is holding in and doing pretty well. Education is doing well. So across the board, credit fundamentals are good.
So no real surge in risky borrowing or unsustainable borrowing at the state level. Is there anything that could really kind of start to trigger some deterioration? Certainly some states may be more vulnerable to a loss in income tax revenues than others.
Well, our market is dependent obviously on income and revenues from taxes and just real estate too. Right. On the income tax side, things are looking pretty good, although you're hearing in some of the financial areas, you might see some reductions, some bonuses and things like that in the financial industry. So you have to watch that because that's a big deal in terms of the revenues. But in the real estate, it's kind of really a little more an area to look at. The cap on state and local taxes reduced the value of the deduction. So some of the areas around New York, New Jersey, Connecticut, a little bit in California, not seeing the growth. If anything, they might be shrinking a little bit in value. So that's something we're watching for going forward.
Fundamentals look solid. Now, one of the things that a lot of folks have talked about this year, at least in Treasury space, is the inversion for a little while of the yield curve. Certainly some folks, we didn't agree, felt that this is maybe a signal of recession, but there's been a really very different story in the muni market. Talk about that a little bit. I've contended in the past that treasuries are more driven by central banks and pensions, maybe investors who aren't thinking about economic trade-offs.
Right, it's kind of started in the summer of 2018 when the Treasury curve was inverting, and we had to spend a tremendous amount of time educating people, let them know we're not inverting. We actually were steepening in 2018 when Treasuries were inverting. Right. So fast forward to 2019, we came into the year with a steep yield curve. It's definitely flattened so much this year, but it is still steeper than other markets. And that's happened because people have gotten more comfortable in the rate environment, flattened a little bit, the long ends perform well, but we're still upward sloping. And the key thing of where we stand today is that when people ask me, where do you find the best value in the market? If you're really looking for the best returns, given that we're an upward sloping market, going out longer, 20, 25 years is beneficial. If you take the volatility that kind of comes with that over a 3 to 5 year time frame, it'll be better. If you're a little more risk averse, not comfortable with that volatility, then that 10-year range is probably a better place to be, just to have the good risk-return trade-off.
Anything that's really got you worried as we think about this next coming, maybe not worried, but that could rock the boat as we go forward?
I guess the things to watch, really, the main thing with us, it gets back to the whole retail demand and how dominant we are by retail. A lot of it has to do with the demand and how comfortable people are taking credit risk, interest rate risk, being in municipal bonds, worrying about rates. So the key thing is really watching that demand, seeing that sentiment. Every week they publish the mutual fund flows of the industry. Just that's a good tracker of how the sentiment is in the industry, seeing how things go. So that's one thing to watch. And then the other is just the economy. I mean, you watch the growth, you watch what's going on, and you just kind of factor all that in, because revenues, every budget has growth in it across the country, and there needs to be some economic growth for everything to work out the way it's projected to.